Ladies and gentlemen, welcome to the Fintech Frenzy. Hope everyone is doing well. I know I sure am. But let's get into some news today. Joy says, Tevis? Huh? What are you talking about? It's Tanner. You know, the host of the Fintech Frenzy, the show that gets about 100 viewers. Ladies and gentlemen, we're going to be talking about a fun little show today, as I saw a comment from the great and powerful data-driven investing online, as well as some commentary around the overall fintech space, and a little bit of commentary from Anthony Noto as well on maybe the health of SoFi. It's going to be SoFi, all across the board. Now, the big interesting story that I wanted to talk about was whether SoFi is going to be beating the S&P 500. I saw in someone's comment already, they said, over how many years? We'll discuss that. Obviously, it's not a forever thing, or I mean, hopefully it is, but that's unrealistic. We're going to be talking about it as an overall investment, since I can't talk about from your perspective, so I'll talk about from mine, about January of 2022 into the foreseeable future. So far from my initial investment, I'm down around 50 something percent, 58%, like that. But from my average, from averaging down, I'm actually just around break even at sort of the mid 7 mark, which is where we are today as well. So very, very slightly green. But it's been a long journey. And for me to have just broken even would be a significant downside for my investment, considering the fact that I've poured, almost 2 years into this, or a little over 2 years into this investment, and, not seen a return that I would have seen from the S&P 500. So let's talk about it. The reason why I'm bringing this up is Data-Driven Investing's comments on X today. He said, I firmly believe SoFi stock will hit an all-time high in the next 3 years. That means $25 or greater by September of 2027, a 3.3x from today's prices. Now, I actually fully agree with this. I think that there's so many things in play that are going to push SoFi to new highs, but it is going to take some time, and that's going to be, very forward-looking. Now, essentially what I took from this is looking, 3 years out from here and trying to see what the rate of SoFi's change will be. If that's my investment thesis, that I think that this will be a potential 3x from here, versus where I think the S&P 500 will be during that time, including the time frame which I've already lost, which is that 2+ years. DCAing since IPOE, I mean, hey, if you thought it was a good investment back then, that was the prerogative. Whenever I was first investing in SoFi, I saw it spike up to really high levels in the 20s, and I thought, because I just started learning about the stock on its last sort of increase. I watched this video of Graham Stephan talking about this little fintech that he was investing in. I think I was watching like Millennial Money or something like that. I forget exactly where it was. Here, I'll show you for a sec. And then I started looking into this, and I was like, oh my God, I want to be a part of this company. Like, they went from being a one product shop to having every single financial service, and the stock is just exploding. I'm never going to be able to catch this stock at a good price. Boy, was I wrong. So I think that was somewhere around this area right here, the $17, $18 mark. But I had missed that bottom, and I just never ended up catching it again, right? Until it actually fell below this sort of, 14-ish dollar. I mean, it was mid 14s where I bought it, which I thought I was buying, within this sort of trading mark where I thought, you know what? SoFi trades within this grade, and I'm going to be able to catch it on the way back up. Boy, was I wrong. It continued to break down lower and lower and lower. And I've been purchasing all along this way. And then it really started to dip below 6s. And then we've been acquiring ever since then. Now, the lowest was $4.24. For the people who bought in that area, which I do know some people who only bought in the 4s, which is just crazy, you guys are laughing, right? The stock doesn't even look bad to you. Everything's going great. You're destroying the indices. So that is a different point of view. But whenever you have a mid seven, average price like I do, let's go from there. So assuming I bought around January of 2022, which is where I did, and you also bought the S&P 500 around that time, you'd be buying, and I can also bring up the S&P 500 as well. SPX, obviously you wouldn't be buying the SPX necessarily, but you'd be buying some level of a SPY or something like that. If you bought around the same timeline, which would be, somewhere over here. Sure, that's close enough. Where is the open? Okay, yeah, sorry. The close on this day was $4,677.03. Okay. Now, let me go ahead and bring up my little notes here. During this time frame, if you would have bought in at my first open and bought in the S&P during that exact same time, instead of if I were to just buy the indices instead of that, I would be, instead of being down 52.8% on that original investment, I'd be up 14.2%. Okay, 14.23%. If you were to have bought in at the lowest points during those periods, you'd be buying SoFi at $4.24. You'd be buying the S&P 500 at $3,491. Okay, so if the thesis is correct, which I completely believe in data-driven investing's thesis, I actually think it will come faster than that. But that being said, sorry, I'm lost here. From a to get from a the average price of $14.50 mark, my original investment, to then the $25 mark over essentially 6 year period, 5 to 6 year period, I'm looking at an increase of 72.4%. In the same period, if I were to have bought in the S&P 500 at that first point, whenever I was investing in SoFi, to today, without all the volatility, with a very slow, gradual increase, I'd be up only 59.24%. Okay. This is assuming the thesis is right that we are going to see that amazing jump up. Now, how do I anticipate the price of the S&P 500 going from today till, September of 2027? I just took an average increase of 10.2%, which is historically what it's grown at. I can't tell for sure whether that'll be the case. It might grow much faster than that. It comes in waves, right? The problem with averaging out is that it might not happen in that perspective. We might see 18%, we might see 21% in a single year. It's definitely not unheard of. We might also see a negative drawback of 10%. So you can increase those numbers if you want. You can decrease those numbers. If SoFi is going to get to that 25% sort of mark, maybe the S&P does better than its average of 10%, but hard to tell. Now, if you ended up lowering your average, like I did, to SoFi getting to $7 and 40 some odd cents, 30 some odd cents, essentially you're looking at a 235% increase on the investment going out to September of 2027. In that same regard, if you bought at the absolute bottom of the S&P 500, not averaging down just slightly, but the absolute bottom, you're only looking at 113% increase. 235, 113. Is it a fair remark? No. But I'm trying to bring this up because everyone says, oh, well, you'll never be able to beat the indices with this investment because you've already lost so much time. And it's a complete fallacy, right? If there is some sort of explosive change in a stock price of or in the stock price of a company, which happens all the time, happened with Robinhood, happened with Palantir, happened with Nvidia, Tesla, a whole bunch of, big stocks, especially in the tech genre, that you can be underperforming the S&P 500 for long periods of time and then drastically beat it, including the times that you have, underperformed the indice. So we'll see. Harry Garcia is saying that he's very happy to have his average in the sixes. Oh, he's delighted in the sixes, very happy in the sevens, satisfied in the eights. That probably means that he's up even more than that. SoFi is down 200%. Oof. I don't think that can happen. I don't know how anything is down more than 100%. Um, I like that idea though. What's it called? Uh, Obviously, the S&P 500 is a much safer bet in terms of you not taking on the volatility, but then you also cap your upside as well. Which is why even, you know, Warren Buffett, for example, tells everyone to invest in the S&P 500, and then he does the exact opposite of that. You know, individual investors can make more than the S&P 500. Everyone makes it out to be like this impossible task, and it's definitely not. It's the people, like I always wondered, like who were those people that you know, potentially are so easily manipulated into buying and selling at wrong prices. And then you see like the SoFi, you know, retail investor base put in their questions on, say, technologies, and they're all like, when dividend, when, when you're gonna buy back $1 billion worth of stock, and then you know they come in whenever the stock is going up and they're saying, wow, what a great company. And then just as the stock turns around in the same morning, they say, oh, this is a shit company. It's like, man, I really have to always remind myself, like the retail audience is so quick to make decisions based on the share price, and you get lost in so much of the potential by holding on for long periods of time. Now, obviously, what's called, that's easier said than done, and that's you guys that I'm talking about. But try to see through the problems of your investing styles, and you know, try to hold on to good companies for longer. And my problem is I've definitely held on to companies too long that were not performing the way I had hoped to. I mean, Skills probably being the most notorious example of that. But that was a real big oversight, in my opinion, being way too growth focused and not seeing the, you know, how much they were going to be spending to acquire those companies. But then I learned from that. Now it's like hard for me to invest in a company like Hims because I know that they could fall into that same sort of trap, and I might miss out on a good opportunity because, you know, I've been burnt by a similar play. But that's that thing with what Warren Buffett said. Like, you're playing baseball here and you're sitting up on bat and they're throwing you baseballs, except you do not have, you know, 3 strikes. You do not have to swing at all. Okay. You only have to swing at the ones that you know are going to be home runs. Don't even mention that company. Yeah, it was not a good play. Burnt by Teladoc. No, I made money on Teladoc. No, that one I did not get burnt on. Didn't lose a single dollar. Um, what's it called? A double for SoFi is easy. It's just a matter of changing macro. I mean, potentially, potentially. I think there's going to be a little bit more to it than that, but I do think that things are going to stack. Like I'm even seeing it with like Palantir. It's like, man, it is true. No one would ever touch that company whenever it was $10. And now you're seeing those same people, well, it's in the mid 30s, and they're saying, like, oh, this is the play after its massive run. It's like, I can't believe the sentiment change just happening over and over and over. And you think that technology and all of these other things, like giving so much information to investors, like looking at the way Peter Lynch used to invest, where his advantage was calling and getting access to the earnings results. Like having SEC filings was your advantage as an investor. To now is just such a crazy change, and yet people still make the same mistakes over and over and over. The only thing different I find is just the total amount of money that's in the stock markets is crazy. Hindsight is a funny thing. Yeah, it's very funny. And even people's talk about hindsight is also very funny. Like I try to, whenever I've missed out on investments or misplayed them, I try to think back to what my mindset was whenever I was seeing them. You know, like it's so easy to tear apart Skills, for example, but you didn't, you like you had to be there. You had to see the growth potential that was there before you can just bash how absolutely terrible management was and how awful they did in like it was a 10x or bust. And in that case, it was a bust, 100% bust. Company's gone. Um, but then you catch a new bank. And then if you were to put $1,000 in new bank and $1,000 in skills, and you ran skills from the highest point down to, I don't even know where it is, but let's say it's 0, and you ran new bank from the point that we first started talking about it to now, you're very happy holding both. You lost your 1,000 and then you made 4,000 over here. You're fine. That's the good thing about being long only and never playing any type of short position, is you can only lose your original investment, you know? But on the long side, you can make multiples of whatever you're putting in. Um, you guys think Grab is the next big? I remember Nubank F4. He says Burbank, but he corrected to Nubank. Yeah. No, and I remember reading it. I'm like, what is wrong with what I'm reading? Like, I remember thinking, like, because I did not put in a large enough investment whenever it was that low. That was my problem. And then people were calling me crazy as I continued to buy all the way up. Like, I remember it was like $7 just sitting flat, and I was like, I'm a buyer here. And people were like, Tanner, you already made your money. I'm like, I have not. This can go so much more. But I wish I bought more under $4 for sure. Let's see. If you sold puts or calls on a weekly basis for SoFi, you'd be doing amazing right now. I bet. But that's hard to anticipate. Let's move on to the next story. So, another thing that I think is very interesting, we covered this yesterday, but let's talk about it even more, is SoFi having potentially a credit crisis because Ally came out talking about how they're in a very bad position. Now, Anthony Noto is a very particular person. He's very interesting. Sometimes you feel like he's talking through signals rather than coming on a podcast. You see this, like, there was a potential offering from, was it Goldman Sachs, that that they potentially offered to buy SoFi, like the entire company, and Anthony Noto turned the investment down. And then, to tell the investor base that he did that, he shorted Goldman Sachs on the social platform that was SoFi Invest at the time. So everyone saw publicly that he shorted Goldman Sachs stock. It was like very little amount or something like this. And then I think he closed it out very, very quickly. But then we found out later that Goldman had attempted to purchase the company and it got turned down. It was something along those lines. It was some story like that. It was a very long time ago. There's been multiple of these occasions where I feel like he's talking through signals rather than through actually communicating. Purchasing his own stock, for example, there was a whole bunch of talk whether it was undervalued, and then 2 days after, there was this a bunch of talk saying that SoFi was overvalued. You saw Anthony Noto purchase stock on the open market, and not only purchase, but purchase and file to say that he's purchased within the exact same day, which he does not need to do. I think there's a 24 or 48 hour window. Well, I mean, definitely 48-hour window, considering it was same day. That was the surprising part. But it was like 2 hours between the time that he purchased and whenever we saw it come up in their SEC filings. So he talks in this very weird way. And then yesterday, or not yesterday, the day before, Ally came out. Stock dropped 18%. They're seeing terrible consumers. Everything's going wrong, and a firm stock drops. Lending Club drops. Capital One, SoFi, massive, corrections in their stocks. 6%, 9% down. It was a bloodbath, just in fintech. Today, Anthony Noto doesn't repeat himself by saying that credit is in a good area, but or the credit default is in a good area. But he does say this. He says, use my referral link to apply for a SoFi personal loan, and we'll each get $300 bonus after your loan is funded. So they're willing to pay for personal loans right now. Like this, they're not going to pull down their personal loan offering for their referrals just based on their own credit performance. I mean, they absolutely could, but they would just potentially not underwrite those loans or potentially not originate them and just say, hey, we're not willing to take on this risk right now, but thank you so much for the referral, but we're not going to take it. No payment needed. Okay. But him coming out and personally tweeting about it just randomly, I haven't seen him do this before. I've seen him do this with the checking and savings products and everything like this. But it is very interesting to me that this is sort of what he's signaling. Whether he's doing this on purpose, I don't know. He did just want to throw his Lord knows he needs the extra money, right? I mean, he made something like 50 or $100 million on Twitter being purchased by Elon Musk. I forget the total amount, but yeah, he could use the $300 from the personal loan referrals to his 80,000 Twitter followers. He might get one subscription, if that. I mean, it was more of a signal than anything, in my opinion. Yeah, I don't actually think that he's going to get personal loans through that. I mean, if you follow like Anthony Noto on X, you probably know that SoFi offers personal loans. Like, I don't think that you need. I think those referral programs are much better whenever you're offering it to a person that doesn't have brand awareness. If you're following the CEO on X, I mean, you probably have some brand awareness of that's their largest product, or to some extent. So I thought it was a good sign. Max Levchin came out yesterday and said he's not seeing credit deterioration the way that Ally is seeing it. Upstart has come out saying their Upstart macro index is still bad, but much better than it was a quarter ago or 6 months ago or even a year ago, and that things are slightly improving. You're seeing this across the board, like at least from the fintechs that I follow, that we're kind of turning the curve, starting to find ourselves on the other side of this massive increase in defaults. Who knows? Oh, is that what it was, Barbecue? Noto scheduled a limit order to buy Goldman Sachs at $665. They were $300. Okay, so maybe that was what it was, because maybe that's what the story was, is that he was indicating that they put an offer in for SoFi at $665 or something along those lines. That's very interesting. They offered a golden parachute at $665. Got you. I remember there was something to say within that story. It's so hard to keep all this crap in my head after years. I'm scared to buy more SoFi, average of $4. I mean, hey, brother, you won. All right. You do you. Maybe it's time, once you have an average of $4. I mean, depending how deep you are, like if you got a couple shares, I don't know. But yeah, like you can go ahead and buy whatever you want. You got your SoFi investment, So it's badass to say we're better than you. Yeah, I mean, Max did. Maybe Anthony did as well. Let's go ahead and move on to the next story here as I wrap up and give a very cool thing. I mean, I don't know if this is what's going to happen. I'm just going to show you guys, and then you guys can take what you will from this. Now, I'm a pretty broad-based fintech investor. Like whenever I invest in fintech, I mean, I've got Cash App, I've got PayPal, I've got SoFi, I've got Shift4, I've got Nubank. What else? I'm probably missing like two more. Anyway, it'll come to me. Now, Jason Mikola has talked about this next big wave in potential banking regulation that is not here to hurt SoFi, but here to actually advantage them quite greatly, potentially hurt my other fintechs. But I know that you guys don't care about those. So let's talk about what is here to benefit SoFi. Senator Elizabeth Warren and Van Hollen expressed concerns over harms possessed by lack of oversight in the banking as a service. He said BAS, but it's BAAS. Banking as a service providers in fintech companies, including specifically mentioning Stripe, Chime, and Cash App. They're asking agencies to ban the use of the FDIC logo for pass-through. Okay, so this is very interesting. Is there going to be, this moment in time where PayPal and Cash App and all of these companies that potentially suggest that they have banking partners that'll cover them in case of insolvency when they're not directly a bank themselves? Okay. So you're looking at this massive fintech arena that has benefited by looking like banks. There's so many fintechs, and I don't mind it. I'm a fintech investor, but that sort of stunt this or sort of strut the same abilities of large banks when potentially there is some concerns that maybe that's not true, right? That you can have problems like a third-party provider like Synapse that goes down and then all customer money is just lost. If you had your money directly with Evolve Bank and Trust, you'd be able to pull that out. You wouldn't need a third party. But if you're going to have your money with Yada Bank and are going through Synapse to get to Evolve Bank and Trust to get that FDIC badge, well, you're going to need, there is a little bit of third-party risk there where they can go bankrupt, and there's really not a banking regulator that protects that relationship. See, FDIC is in place whenever the bank goes insolvent. But the bank service providers in between that, there's no system there. You ought to use another bank. Now, for SoFi, if you guys don't know, I mean, I hope you do, especially if you're looking into this stock as an investor. Although it's considered a fintech because it's financial technology, it's within that sort of era, they are a fully regulated bank. I mean, as regulated as JP Morgan or Bank of America, okay? They're a nationally chartered bank. They have that license, and so they get to play with the big boys. But that also means that there's no realm where the FDIC badge gets taken away from SoFi. They own it directly. It's not through a partner bank. They own it. So could this potentially, be better for SoFi if some of their competitors like Venmo or Chime or Cash App, where you're looking at over 100 million users right there, 150 million, no longer have that sort of badge that people very much need? Thank you all so much for watching. I really do appreciate your time. If you like this sort of stuff, make sure you follow me on X. But aside from that, that's all I ask. Thank you all. Bye for now.